There is a single three-digit number that quietly controls more of your life than almost anything else you own. It decides whether you get approved for a loan, how much interest you pay, whether you can rent an apartment, and sometimes even whether you get the job. Most people have no idea how this number is actually calculated. They just hope it goes up. By the end of this video, you will understand exactly how your credit score works, what moves it, what quietly damages it, and how to take real control of it. No confusion, no myths, just the clear version nobody bothered to explain to you. So what is a credit score really? At its core, it is a prediction. It is a number, usually between 300 and 850, that tells lenders how likely you are to pay back money you borrow. A high score says you are reliable and low risk. A low score says you might be a gamble. That is all it is. It is not a measure of how much money you have, or how smart you are, or how hard you work. Plenty of people with high incomes have poor scores, and plenty of ordinary earners have excellent ones. Your score is simply a track record of how you have handled borrowed money over time. Here is why this number deserves your attention. The higher your score, the less you pay to borrow. On something as large as a mortgage, the difference between a great score and a poor one can add up to tens of thousands of dollars over the life of the loan, all because of the interest rate attached to your number. A strong score unlocks better credit cards, lower rates, higher approval odds, and more negotiating power. A weak one quietly taxes everything you do with borrowed money. So improving your score is not about vanity. It is one of the highest return moves in all of personal finance because it lowers the cost of nearly everything. Now, let us break down what actually builds the number, and we start with the biggest piece by far. Payment history makes up about 35% of your score, more than any other factor. It answers one simple question: do you pay your bills on time? Every on-time payment quietly strengthens your score. Every missed payment, especially one that goes 30 days or more past due, can do serious damage that lingers for years. This is why the single most powerful habit for your credit is almost boringly simple. Pay every bill on time, every time. If you do nothing else from this video, automate your minimum payments so you never miss one by accident. The second biggest factor is credit utilization, which is about 30% of your score. This one trips up a lot of people, so listen closely. Utilization is the percentage of your available credit that you are currently using. If you have a card with a $1,000 limit and you are carrying a $500 balance, your utilization is 50%, and that is high enough to hurt you. The general guidance is to keep utilization under 30%, and under 10% is even better. The powerful part is that this factor resets every month. Pay your balances down and your score can improve quickly, often faster than with any other factor. The third factor is the length of your credit history, worth around 15%. This is simply how long you have been using credit. It looks at the age of your oldest account, your newest account, and the average age across all of them. Older is better because a long track record gives lenders more confidence. This is why closing your oldest credit card can actually backfire. It can shorten your average account age and shrink your available credit at the same time. So in most cases, keeping old accounts open, even ones you rarely use, quietly works in your favor. Time is doing the work for you, so let it. The fourth factor is your credit mix, worth about 10%. Lenders like to see that you can responsibly handle different types of credit. That might include revolving credit like credit cards, and installment loans like a car loan, a student loan, or a mortgage. A healthy variety signals that you can manage different kinds of borrowing. Now, this does not mean you should run out and take on a loan just to improve your mix. That would be a mistake. It simply means that as your financial life naturally grows and you take on different forms of credit over time, that variety can gently support your score. Do not force it. The fifth and final factor is new credit, also about 10%. Every time you apply for a new credit card or loan, the lender runs what is called a hard inquiry, which can temporarily ding your score by a few points. Opening several new accounts in a short window can signal risk, like you might be desperate for money. This is why spacing out your applications matters. One important note though, checking your own score does not hurt it. That is called a soft inquiry, and you can and should check your own credit as often as you like. Only applications from lenders cause the temporary dip. So let us turn this into action. To build your score, pay every bill on time, keep your utilization low, keep your old accounts open, and only apply for new credit when you actually need it. Avoid the common traps. Do not max out your cards, even if you pay them off, because the balance reported can still spike your utilization. Do not close your oldest card on a whim. Do not apply for 5 things at once. And do not fall for promises of instant credit repair, because real improvement comes from consistent habits, not shortcuts. The good news is that your score is always moving, which means you can always rebuild it. Your credit score is a prediction of how reliably you repay borrowed money, and it is built from 5 parts. Payment history is the biggest, followed by how much of your credit you are using, then the length of your history, your mix of credit types, and how often you apply for new credit. Master the first 2, which are paying on time and keeping balances low, and you have already won most of the game. This number quietly shapes the cost of your entire financial life, and now you know exactly how to move it. If this made credit finally make sense, subscribe, because we are breaking down every money tool one video at a time. Thank you.